Hello friends. In the last video, we discussed why housing loan plus SWP might be a financial trap. Then in that case, is there a way around this? Can we do something where we can save the housing loan interest that we pay on a month-on-month basis? That's what we're going to discuss in this video. Welcome to Aarti's Tax Info. So let's take the same example as that we took in the last video. We're taking a housing loan of 50 lakhs for 20 years at the rate of interest of 9% per annum. So the EMI will come to around 45,000 per month. There is a common misconception among people that housing loan is the best loan available. You can purchase a house and the tenure is 20 years or 30 years. So you have a lot of time and the EMI is also very reasonable. But the actual fact is that in this case, if you take the example of 50 lakhs loan at the rate of interest of 9% per annum for 20 years, for this 20-year tenure, you end up paying more than 1 crore. That is twice the amount of the actual loan. If the tenure is actually 30 years, you end up paying around 1.5 crores. That is thrice the amount of the actual loan taken. So what is the solution for this? In this particular example, the total interest that you pay for 20 years comes to 58 lakhs. So this is why you employ the 10% rule to save the interest. So you choose an SIP which gives you 15% returns per annum and invest 10% of an EMI amount into that. So 10% comes to 4,500, but for the ease of calculation, we'll take it as 5,000. So if you invest 5,000 per annum for 20 years, the wealth gain that you have at the end of 20 years will be 64 lakhs. This is only wealth gain and not the total returns. But in case of the SIP that I've chosen didn't perform as good as you thought it would, and it ended up giving only 12%. 12% is a guaranteed minimum return that you get if you choose a good SIP. So if it's 12% per annum, you extend the SIP for a period of 23 years. So at the end of 23 years, you get around 60 lakhs. And the interest that you've paid for 20 years gets compensated this way. So this is how we negate the interest part in the housing loan and end up having a no-cost EMI housing loan. So you're not satisfied with this. You still want something extra. You want some savings at the end of 20 years. Is there a better option? There is actually. You employ the 10-10 rule. So what is 10-10 rule? Apart from the 10% SIP that you invest every month, you still have some extra income. Say 10% more. That is 5,000 extra. So you start paying 5,000 extra EMI every month, over and above the 45,000 that you're paying as a monthly EMI. So what is the use of this? Whatever you pay over and above your existing EMI reduces the capital of the capital part of the housing loan. So the capital starts getting reduced at a faster rate, and you end up closing a housing loan at the end of 16th year, or to be 15.5 years to be precise. So what are the savings here? Your interest, that is 58 lakhs, comes down to 54 lakhs. And as the loan gets closed in 15.5 years, for 4.5 years, you don't have to pay the EMI. So that savings will come to around 24 lakhs. So if the SIP is giving you a return of 12%, you'll end up with a saving of 30 lakhs at the end of 20 years or 23 years. If the SIP is giving a return of 15%, at the end of 20 years, you end up with a savings of 34 lakhs. So no matter what the value of the housing loan is, be it 50 lakhs, 75 lakhs, 1 crore, 1.5 crores, or even 2 crores, if you employ the 10% rule, you will end up negating the interest part of the housing loan and get a no-cost EMI housing loan. If you employ the 10-10 rule, you'll end up with some savings at the end of the tenure. I hope the information was useful. For more such information, please subscribe, like, and share. I'll see you in the next video. Thank you.